Hi, everybody. Welcome to the January 2026 Economic and Market Update presented by Commonwealth Financial Network. My name is Chris Fasciano, and I am Commonwealth's Chief Market Strategist. December was a mixed month for markets, capping off an otherwise positive year for investors. The Nasdaq ended the month down slightly, while the S&P 500 and Dow Jones Industrial Average both saw modest gains. Despite the lackluster end to the year, markets had a strong 2025, with all three major U.S. indices up between 15 and 21% for the year. The story was even better for international stocks, which rallied in December to close out a strong year. Developed international and emerging markets both saw 30% plus gains for the year, supported by a weaker dollar and shifting investor demand for international stocks. Even bonds had a solid year, as lower interest rates helped support bond prices. Despite a modest drop in December, the Bloomberg Aggregate Bond Index ended the year up over 7% on a total return basis. Both short and long-term interest rates fell for the year, supported by Federal Reserve policy decisions and cooling inflation towards year-end. The 10-year Treasury yield fell from 4.57% at the start of 2025 to 4.17% by the end of the year. The drop in long-term interest rates were echoed by similar declines in short-term rates, which were in turn supported by 3 interest rate cuts from the Fed at the end of the year. The falling rate environment was a tailwind for both bond and stock valuations throughout the course of the year. Aside from falling interest rates, markets were also supported by solid fundamentals. Earnings growth was strong throughout the course of the year, with better than expected growth for most sectors. As we approach the start of fourth quarter earnings season, expected earnings growth for the S&P 500 for 2025 is more than 11%, with growth of another 14% currently the consensus for 2026. This is impressive performance in any environment, but rather stunning in the face of existing potential economic headwinds. That said, the economic backdrop remains supportive. Despite some signs of weakening, the economy continued to expand throughout 2025, as shown by the impressive 4.3% annualized GDP growth rate that we saw in the third quarter. Consumer spending has remained resilient and helped power the overall economy throughout the course of the year. This is expected to continue in 2026. However, we have started to see some signs of weakness in various areas of the economy. Cooling job market remains the primary risk for the economy as we head into the new year. Hiring slowed notably throughout the second half of last year, which is a concerning sign for both businesses and consumers. This slowdown was the primary reason for the Fed interest rate reductions at the end of the year, as the central bank eased policy to try and support their goal of maximum employment. Having a healthy labor market ultimately helps support consumer spending and overall economic growth. So this will be a key area to monitor in the months ahead. Markets face additional risks that should also be kept in mind as we head into the new year. Policy risks remain domestically, as uncertainty from Washington has the potential to increase market volatility. 2026 also brings with it midterm elections in November that could potentially amplify policy uncertainty later in the year. Foreign risks remain as well, with ongoing conflicts in Europe and the Middle East serving as continued sources of regional instability. While the direct impact of these events on U.S. markets has largely been limited, these sources of geopolitical uncertainty should be monitored, as they could negatively impact markets in the future. Despite these risks, we remain in a pretty good place to start the year. Market fundamentals were impressively resilient throughout the course of 2025, and analysts expect to see further improvements ahead. The economic background is still supportive for investors, despite the risks posed by a cooling job market. The most likely path forward remains continued economic and earnings growth, leading to market appreciation in the year ahead, despite the potential for short-term setbacks along the way. That's it for this month's update. I'll be back next month to walk through whatever the markets throw our way. Take care, and thanks as always for watching.